In this topic, we'll treat trading agents as decision support systems, not autopilots. We'll connect market signals to research, simulation, backtesting, and risk controls, so any move toward execution is measured, monitored, and constrained. You've already connected the major building blocks: agent reasoning, wallets, signing, smart contracts, DeFi tools, event monitoring, and autonomous workflows. Now we'll bring them together as market-focused agents that watch on-chain activity, support trading research, and detect arbitrage opportunities before turning these capabilities into startup ideas. Think of a trading agent as a disciplined pipeline, not an autonomous money machine. It observes prices, liquidity, order flow, wallet activity, and market news. It analyzes patterns such as discrepancies, volatility spikes, or unusual risk changes. Then, before anything moves toward execution, it simulates outcomes and turns findings into alerts or trade proposals. The key control is separation. Analysis can be automated, but approval and execution should remain gated, auditable, and human-supervised. A market monitoring agent needs a radar, not a single data source. Prices may come from DEX pools, aggregators, centralized exchanges, and oracles. Liquidity shows whether those prices are actually tradable through reserves, depth, volume, and slippage. Wallet activity can reveal intent: whales moving funds, treasuries rebalancing, bridges heating up, or contracts emitting events. Off-chain context adds the why from news, governance, social chatter, and sentiment. The agent's edge comes from combining these signals into one coherent view. On-chain pricing begins at the pool level. Reserves, recent swaps, depth, and volume show what traders are actually paying, not just what an API reports. But one source is never enough. An agent should compare AMM pools, curve-style pools, aggregator quotes, and oracle feeds. Then watch for stale updates, thin liquidity, sudden divergence, or manipulation. When signals agree, pricing confidence rises. When they disagree, the right next step is deeper simulation before acting. Whale monitoring connects wallet behavior to possible market impact. A large transfer, exchange deposit, bridge move, or treasury action may suggest changing intent, but it is rarely conclusive on its own. The signal becomes stronger when wallet activity lines up with liquidity changes, such as falling reserves, imbalanced pools, or rising volume. An agent should treat this as context, simulate slippage and downside risk, and alert humans before conditions deteriorate. Some market signals appear before anything happens on-chain. Official blogs, governance forums, unlock schedules, security alerts, and regulatory updates can shift expectations early. Social channels add speed, but also noise. The agent's job is to classify each signal by source quality, urgency, reliability, and likely impact. I can summarize long discussions and detect repeated themes, but it should not replace verification. Treat rumors and viral engagement as hypotheses, not evidence until confirmed. Market data becomes useful only after it is made consistent. Raw inputs are cleaned and deduplicated, so the agent does not treat the same event as multiple signals. Values are normalized across timestamps, token addresses, chain IDs, and units. Then the system scores features like momentum, volatility, liquidity, sentiment, and anomaly severity. The result is structured memory. Observations the agent can query, compare over time, backtest, and turn into alerts or simulations. Treat every proposed trade like a flight that must pass the simulator first. Paper trading checks whether the agent's decisions make sense without risking funds. Backtesting asks how those decisions would have behaved in past markets. Transaction simulation tests the actual route, approvals, gas, slippage, and contract calls. Finally, failure modeling asks what breaks when prices move, RPCs lag, liquidity vanishes, or MEV appears. Only after that should live execution be considered. Backtesting asks, would this strategy have worked in the past? Paper trading asks, can it behave sensibly right now without risking capital? Use both. Historical tests reveal performance, drawdowns, and sensitivity to assumptions. Live simulation exposes latency, missed fills, slippage, and operational issues. The goal is robustness, so test across bull and bear markets, different tokens, chains, and volatility regimes. not just the conditions where the strategy looks best. An apparent spread is only the starting point. Before an agent trades, it should simulate the exact route and estimate what will actually arrive after price impact. Pool depth, routing complexity, gas, bridge costs, aggregator fees, and priority fees. It also needs a buffer for MEV, including sandwiching, front-running, and back-running, plus the cost of failed transactions. If the conservative net result is not clearly positive, the correct action is to reject the trade. Arbitrage agents scan for price differences across DEX pools, aggregators, centralized exchanges, or chains. But a visible spread is not the same as profit. The agent still has to validate liquidity, fees, latency, block timing, RPC reliability, MEV risk, and competing bots. In practice, the safest design is often detection plus validation, followed by an alert or human approval, rather than fully autonomous execution. Trading agents need hard boundaries, not just good prompts. Set limits on position size, trade size, daily volume, and exposure by asset or protocol. Define automatic stop conditions for losses, drawdowns, volatility spikes, or repeated simulation failures. Before execution, require enough liquidity, acceptable slippage, fresh Oracle data, and agreement across price sources. Finally, require human approval for large trades, new tokens or contracts, strategy changes, and unusual markets. Autonomy should shrink as risk increases. A safe market monitoring agent should not jump from signal to trade. It starts with read-only services. Every proposed action is simulated, checked against policy, and scored for risk. Only after approval can it reach isolated, rate-limited signing infrastructure. Around the whole path, observability matters. Logs, dashboards, alerts, incident records, and a kill switch help teams investigate, pause, and improve the system without losing control. Market agents are powerful because they combine signals, speed, and execution. But trust comes from discipline. Observe broadly, simulate before acting, enforce strict risk limits, and escalate high-stakes choices to people. Next, we'll turn these patterns into startup ideas that are useful, defensible, and safe enough to scale.